Welcome to another real estate industry update. I'm your host, Daniel Racanti, here with Kyle Paxton. Today's topic that we're going to talk about is the dreaded business interest expense limitation. I think this is one of those topics that probably gets overlooked a lot and does actually affect a lot of our real estate clients. I know Kyle deals with this a lot when he deals with his funds and his syndications. And for most of our real estate people, maybe it doesn't affect it, but I think you should still understand it. There was a recent law that passed when the One Big Beautiful Bill that also was a major revision back to this. Actually was a positive for our real estate investors by adding back depreciation amortization in the calculation, which basically allows us to take more of that deduction from our interest expense. And so let's kind of get just a high level understanding. What is the business interest expense limitation, Kyle?
Yeah, so back in, feels like a lifetime ago now, but in 2017, when the Tax Cuts and Jobs Act was passed, a provision, affectionately we call the code section, of what we call 163J was included. And what that did was it limited your business interest deductions in certain scenarios up to 30% of what's called your adjusted taxable income. I've already lost half of the audience here. Super convoluted. What is adjusted taxable income? Well, in 2021, it was EBITDA, earnings before interest, taxes, depreciation, amortization. Then in 2022, things started to change. So they took out the depreciation and amortization, and this crushed a lot of people. A lot of my clients were impacted. We planned pretty well around it, but still surprises came out of it. So before I get too in the weeds here, I'm just kind of taking a step back. Ultimately, what happened was in certain situations, if your business falls into two distinct categories, number one, you're a large taxpayer in the eyes of the IRS. For 2025, that is 31 million of average gross receipts over the last 3 years, or you were deemed a tax shelter, which is commonly you have a loss in your business and more than 35% of the losses, taxable losses, are allocated to limited partners. You fall into this bucket. And so in this calculation, you have your business interest expense, which can include mortgage interest and all the other shapes and sizes of interest. If you're a car dealer, your floor plan financing interest, and that interest expense was subject to and continues to be subject to this test. I've seen many taxpayers who were burned by this, cut off by this. And depending on how your business is structured, if the interest is limited, if you're operating in a partnership, if the business is limited at the partnership level, that limited interest flows down to the partners and carries forward indefinitely at that partner level until you have excess income in the future to deduct the interest. So no fun. It's been a mess. But as Daniel mentioned, he had to say One Big Beautiful Bill as soon as the video started. I could tell he was so excited to rattle off that name. But they threw us on there, and like I said, 2022, that depreciation add back was taken away, which crushed a lot of people. They brought the depreciation back, and so that's going to pull a lot of people out of this trap.
Yeah, I mean, this was a great add back for the new bill out here for real estate people. This is a win. And so let's kind of understand, like, who does this affect? Because this is called business interest expense limitation. So this is all businesses potentially. It's not just real estate businesses,
right?
But it does affect real estate. And there's also some unique components for real estate to actually kind of get out of this, okay? So this is mostly going to affect in the real estate space is going to be these highly leveraged partnerships, these syndications, these funds, or these developers. Anyone that's going to be having significant interest expense, okay, and hoping to be able to take that large deduction. Kyle mentioned this already, but if you have gross receipts over 31 million, they're average over 3 years, you don't get the small business exception exclusion, basically. So like I said, it's not just real estate. So normal businesses that are very large still have to deal with this limitation. So if you're under 31 gross receipts, which, is going to still probably be most people, because that's a pretty large business. But the big component here that always hurts real estate is the tax shelter. Okay. So if 35% of your losses are being allocated to limited partners, so these are going to be your syndications, these are going to be your funds, okay, then you do not get the small business exception here. You're going to be subject to 163J and this business interest expense limitation, unfortunately. Okay. So let's kind of do a quick calculation of like what does this truly look like? Okay, because we've talking about a lot of things, but how can it truly limit your business? All right. So
Daniel,
I'm gonna do a
before we
quick
dive into that, you mind if I cut you off here? And I want to clarify one quick thing that I think is
sure.
important. The $31 million of gross receipts is across all of your businesses in which you have constructive ownership in. So if you have 6 different businesses, 6 different real estate entities that have $6 million of gross receipts each of these are potentially subject to the test if they have common ownership. So something I want to clarify there. It's not looked at necessarily the individual business level. Sorry, Daniel, give us our example. Let's go.
Right. There's one thing Kyle has to do is he has to make it more complicated than what it really is. But yes,
If
he's true.
it impacts more people than you're making. All right.
The limitation can be at the entity level, but it could also be at the taxpayer level. So you do have to look at both of these. So I just want to do like a quick calculation because I don't know about everyone else, but I learn better when I have a real example, a real life example here. So let's say that you have a syndication or a fund or something. So you're a tax shelter. So you're subject to this. Okay. And before the limitation, you have a $200,000 loss. Okay. Now we, under the current 2025 law here, okay, so we get to add back our interest expense and we get to add back our depreciation and amortization. All right. So I'm going to say my business interest expense is 600,000 and my depreciation is 500,000. All right. So when I add back that $1.1 million, now I have adjusted taxable income of 900,000. Okay. So before all this started, I had a $2,000 loss. My adjusted taxable income is 900,000. That's what is going to get times by 30%. So I can calculate what is my actual limitation. So 30% times 900,000 is 270,000. All right. That's my limitation. All right. And then the $330,000 of interest expense is getting disallowed. Okay. So I went from having a $200,000 loss to now I have to back out 330,000 of that. And now I'm actually going to have taxable income of 130,000. So thought I was going to allocate everyone loss. Now I'm allocating everyone income because of this interest limitation. This is why this is very important for a lot of our syndications and funds, because your investors, one of the reasons why they invested in this is to get these tax losses. Okay. And now you created a situation where you thought you were going to give a tax loss and you're being limited, and now you're actually giving income to all your investors.
But wait, there's a solution, right?
There is a solution, Kyle. So let's talk about, okay, I'm a real estate business. I'm going to be affected by this. What are some of the things that I can do to help me in this situation? So I'm not having to go back to my investors and be like, hey, I'm sorry, you actually got income this year.
So one of the things we do when we onboard, as Daniel mentioned, we see this time and time again with our real estate funds, right? So one of the things we do when we onboard our real estate funds is we look at this very closely because it impacts all of them. And so one of the things we do is we will consider what's available to us known as the real property trader business election. And so if your real estate activity qualifies as a real property trader business, what that allows us to do is it allows us to elect out of this 163J regime. Hooray, big win, very exciting. As with everything with the IRS, there's always a catch, as we know. And so the trade-off is in electing out of this 163J regime, you have to switch your method of depreciation from makers, which is generally faster, more advantageous, the preference in most scenarios, to ADS depreciation, which on your real property has a longer recovery time. And the real property components and the qualified improvement property for the commercial folks, There's longer recovery period, and they are not eligible for bonus depreciation, those subset of items. So what we look at in kind of making this calculation is which one is better for the company to be able to take the depreciation and limit a portion or all of the business interest, or the reverse, right? You get to deduct the interest, you slow down depreciation a little bit. Both of these things are timing differences. So it really is just optimizing cash flow and figure out what's going to get us our big bang for our buck. And so that is part of the, as you're setting these things up, the entity structuring is extremely important, and, looking at tax optimization and elections to make sure we're taking advantage of the avenues in these code sections to get around these traps.
Yeah, the bonus depreciation that you can't take is the biggest drawback here. Yeah. And that's really the one you want to consider when you're optimizing. Thankfully, in 2025, the add back of depreciation and amortization has made this a whole lot better. Before all this, man, you had to do the whole depreciation. So let's say I bought a property, I'm selling my investors a cost segregation, and you're going to get this huge deduction year one, and then you get all this interest limitation to do it. Because if you go and you make the election, because you're a real property trader business, and you have to move to ADS, now you don't get bonus. So you don't get the huge bonus depreciation deduction, but now you get more interest. So it's just playing with numbers here. Thankfully, with the add back here, going back to the older laws, it's more favorable, especially for the real estate business here. You're going to see a lot more people not having to make this election. I think, unfortunately, Kyle and I know this election had to be made for a lot of our clients just because, and it's an irrevocable election. So once you make it, you're stuck with it. So you don't get to go back and take bonus depreciation or anything like that. So you want to make sure that you make this election, you're okay and you're stuck with it going forward. I think with this add back, you're going to see a lot more people going back to the cost segregations and everything with the interest limitation, even though being in play because the depreciation is being add back. And I want to also follow up, even though your interest is getting limited, it doesn't mean it's lost. It carries forward indefinitely. And then we have to do the same calculation again next year to see if your depreciation is a lot, or your interest is a lot less next year, then you could actually potentially take all that disallowed interest expense that you could have in the prior years, in the current years, and you can actually get a bigger deduction. So there's a lot going on here, but this really affects that taxable loss that you're hoping to give all your investors. And so it's an important piece, and you want to make sure that you fully understand the situation and fully understand the rules. So tax time doesn't come around. You're surprised, your investor's surprised, and we have a lot of hard and difficult conversations we now have to have.
Yep. 2 quick notes on that, just to further the example and kind of the pain that this has caused in years past. In 2022, when the depreciation add back was taken away, I work in the dealership space. Is kind of my side gig from real estate, right? And in that scenario, I had a dealer who purchased an airplane in their business, and that is a huge depreciation, wiped out taxable income for them. Oh no, they have a lot of business interest expense, and so not being able to add back that airplane depreciation created a problem we had to work around. Just an unforeseen tax consequence in doing so. You would think like those two things are not generally related at all, right? But this code section trapped them. And then the second thing I want to point out, in the real estate space, we have so many clients that have tiered entity structures, right? So you may have the partnership that holds a multifamily property that is a syndication, has 100 partners. The GP has another LLC below it that's taxed as a partnership that's flowing their interest through. We've mentioned a couple times that any limited interest flows down and carries along with the partner. If your interest expense passes the test at this first tier, so your multifamily property, if you either make the real property election or you do the test and you pass, that interest doesn't get tested again at each tier down the line. It's a one-time test. Did you get it or not? and then it's free all the way down. So you don't have to worry about, 3 tiers down the line. Do I have enough income to offset? It's a one-time test, and then you're home free. And so again, it's a little nuanced, but an area where I see some confusion around is how that flows down. So there's a test at the entity level, and then kind of whatever the results of that test are, what flow.
That's good to talk about, Kyle, because I think a lot of people don't realize, like, when you invest in real estate, you could be investing in multi-tiered partnerships, things like that. And those are all flowing through. So all this business interest limitation is flowing through. And so how does that get limited or passes through at each level? So Kyle, let's talk about a little bit about what can we do? Okay, what can we plan, strategize around this? I think one of the things is let's fully understand what kind of debt we're taking out. Traditional kind of debt is going to fall under this business interest expense limitation. Okay, so is there ways around it? Can we use some kind of preferred equity? Can we be doing anything else that's not going to actually produce interest expense? That's some ways you can kind of shift around this. Okay. But you probably aren't going to be able to avoid it altogether. If you're investing in real estate, the whole point of doing it is so that you can use leverage, okay? And then there's great things like cost segregations and a refi cash out, and you're probably wanting investors, so you're selling investors on all these things. Like, I'm going to buy this real estate, we're going to improve it, we're going to get refi it, and I'm going to give you all your money back, okay? So think about that though when you're doing it and you're selling this product. Like, what is my IRR? What is my rate of return? What is my cash on cash return? Like, when you're selling these to your investors, really need to understand and evaluate how these limitations are going to affect it, so you don't oversell to your clients. Okay, you are giving them true transparent. You don't want to be saying, "Hey, I'm going to give all your money back, and I'm going to give you all these losses," and then really they actually get income on their return. Okay. We need to fully understand that, what Kyle and I see a lot is this doesn't get thought about at the purchase, before the purchase, when you're getting the investors, and even at the purchase. And then it comes to tax time and I need a tax return. And then they're like, "Oh, we don't understand what just happened." Okay. Why do we have all this income all of a sudden? All right.
What I'm hearing is bring your accountants in early.
Or most importantly, just, it's like you're not giving your investors what their expectations are. That's what you want to meet. Okay. You want to meet their expectations. When you don't meet their expectations, and either way, I mean, most investors are going to be happy if they get more for deduction than they were expecting. Okay. But they're quick to call you when they're not getting the ones they were expecting. It goes the other way. So just keep that in mind, because the more your investors are happy, the more likely they're going to keep doing deals with you and everything. So just best practice here is just get out in front of it, get a good projection modeling going on so you can project what the true limitations are going to be here. What are my options? What are the carry forwards potentially? Because like I said, you don't lose the deduction. You just get the carry forward in future years. You still will get it at some point. You just might not get it as quickly. And the whole point of a lot of these investors who get into deals is you're selling this huge deduction that they're going to be able to take on their tax return.
Yep. And, one more point I kind of want to reemphasize is that your financing mix and optimizing it is such a dollars and cents driven decision. It's so numbers on a spreadsheet, right? You're looking for a certain return. You're looking for everything. And this has a sneakily significant impact on those numbers. Definitely something you want to have your head wrapped around and be aware of. Unfortunately, 2025, things are looking brighter on this front, and there's less of our clients will be fall into these traps. But still, it's a nuanced, complicated area. The law is hundreds of pages long to get this thing across in 2017. Another, I don't know how many pages of BBBA, but it's a lot. So it's a lot to stomach and flow through. So just something to be aware that it exists and pay attention to.
That's good, Kyle. So let's kind of just go over some quick summary points here before we end this episode. So just kind of some main points here is like, know your leverage position. Okay. I mean, You need to be calculating what your adjusted taxable income early is so you can anticipate these limitations, okay? But you need to model both scenarios. What are you going to do if you do with or without the real property trader business? So we talked about this already. Thankfully, with the add back of depreciation, we don't have to add the cost segregation in there like we had before. But now it's like, all right, should I make the election? Should I not make the election? What does this look like? All right, because you're going to have to make the election early life into the property, and then it's kind of irrevocable, unfortunately, afterwards. Plan ahead for your carry forwards. All right, if you are going to get disallowed, it's not the end of the world. It just happens sometimes. It could still be a really good deal. You just need to be planning for this. And then when you're telling your investors, when you're giving them projections of how well it's doing, saying, hey, we still got all this interest expense. The guy got disallowed, but you're getting it in future years. Here's where we project that it will actually be given to you. And so you're still getting that full deduction. You're just not getting it front loaded like you have maybe in some of your other deals or in the past. It's just going to be a little bit more evenly spread out. And then Kyle mentioned this earlier, but you really need to be bringing your CPA in as early as possible to really be analyzing these deals before the purchase. If you're doing any kind of debt restructuring and refinancing, this is a big one for us. Say you didn't have any interest limitation when you bought the place because you bought it with little to no debt. You're using investors' money or things like that, but you sold them on the cash out refi. You did, and you go, okay, I'm doing a cash out refi. Here it comes. This is after even the cost segregation is done, after everything. So depreciation is very low going forward, and now it gets limited on this interest. And now they're actually getting a decent amount of income coming from this investment going forward. That's probably where I see the most negative effects here is actually on the cash out refi, just because investors got their money back, but they also got a lot of taxable income with it, unfortunately. Thank you for tuning in today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. Join us next time for more expert insight and tax strategies to help you maximize your real estate investment. Till then, stay informed, stay proactive, and happy investing.
Thank you.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.